Hi everyone, what's up? Welcome back to my tutorial channel. It's Dania here, and today I'm gonna talk about behavioral finance. So in this video, I'm gonna first talk about the market anomalies to efficient market hypothesis, some basic types of anomalies. Then I'm gonna show you a couple of main behaviors of individual investors, and finally I'm gonna show you some practice. First, market anomaly to efficient market hypothesis. A market anomaly is a violation of market efficiency whereby, if true, a relatively simple trading strategy that relies either on a record of past prices, publicly available information, or certain market factors can generate superior returns. Note the following caution about market anomalies. First, just because they happened in the past doesn't mean they will necessarily happen in the future. Second, some require higher frequency trading to explode and cannot be explode. The average investor is too slow to react to an arbitrage opportunity. Your technologically advantaged competitors may have reaped all the benefits available before you take action. Number 3, they may be spurious and artifacts of data mining. If you can dig deeply into a large dataset, you are about to find some interesting relationship, but it is possible that such conclusion could be spurious and not reliable in general. Now we are going to consider some time-based anomalies. There may be certain times where investors have higher opportunity to take advantage on the market than other times. Number 1 is the January effect. Usually the returns are observed to be higher in January and lower in December somehow. The second effect is Monday effect. Returns are observed to be lower on Monday somehow and higher on Friday. Number 3, time of day effect. Returns are observed to be more volatile, relatively higher trading volumes at times close to both market open 9:30 a.m. Eastern Time and market close at 4 p.m. Eastern Time in the United States. Next, anomalies when investors overreact or underreact to a news. Here we revisit the semi-strong form of EMS and consider where the investor either overreact or underreact to a news initially and need additionally time to process it. We offer 3 of the most commonly seen anomalies or puzzles. The first one is new issue puzzle. When a news come out, the investor can either overreact or underreact to the news. Number 2, earnings announcement puzzle. Number 3, momentum effect or reversal effect. The momentum effect states that there is positive zero correlation in stock prices, leading to the investor underreaction, while the reversal effect states the opposite. That is, there is negative zero correlation in stock prices, leading to the investor overreaction. So these are 3 types of anomalies corresponding to the second forms of EMH, the semi-strong form. So the first group here, the time-based anomalies based on time. The second group is based on the new information coming out. Basically the second forms of EMH. Now we consider some other anomalies that are harder to explain. The first one is CME strings. One would expect that 2 securities with claims on the same cash flows which still trade separately should trade at the same price, but this is not always the case. Second, political political cycle effects. The first and the last years of a political administration have higher returns versus other years, perhaps as the market reacts to expected upcoming policy changes. Number three, stock split effect. When a stock splits, it has higher returns both before and after split announcement. A stock split often occurs when the stock price is too large. Number four, neglected firm effect. Small firms neglected by analysts have higher returns. Number five, Super Bowl effects. When the winning team is from the AFC or NFL markets, do worse than the winning teams is from NFC. So these are some other anomalies that are harder to be explained. Next, bubbles and irrational exuberance. Bubbles are not market anomalies per se, but are an example of a market efficiency. In a bubble, prices for certain assets increase irrationally. Investors raise prices for these assets far above any reasonable valuation. After a while, the bubble bursts, leading to huge losses for those holding the assets. There have been three bubbles in the last 30 to 35 years. The first one is Japanese stock and real estate bubble from late 1980 to late 2000s. Number two, technology or dot-com bubble in late 1990 to 2002. Number three is the U.S. housing bubble from 1996 to 2006. Now we consider three forms of bubbles. The first one, the Japanese stock and real estate bubble. In the late 1980s, the Nikkei 225 rose about 300%, but after interest rates increased sharply in the early 1990s, stock prices soon thereafter lost about 50% of their value within 9 months. By the late of 2000, stock prices were down 80% and real estate prices had fallen 87% from these peak levels. Number two, the technology or dot-com bubble. In the late 1990s, the Nasdaq Composite Index rose about 580%, peaking in early 2000. By late 2002, prices were down 78% from their peak levels. Many of the most volatile stocks during this time were high-tech or dot-com stocks, many of which no longer exist today. Number three, the U.S. housing bubble and crisis from 1996 to 2006. U.S. housing prices increased nearly 300% as many investors assumed that prices could only continue to go up, and banks extended credit to individuals beyond what normal lending standards would allow. By March 2009, U.S. home prices were down more than 30% from their peak. So these are the three examples of bubbles. Now the last thing I want to talk about today is the behaviors of individual investors. Here I introduce just 7 main effects. You can find more effects on some textbook or resource, but here I introduce only 5 most commonly used effects. The first one is diversification effect. Risk can be reduced by appropriately diversified portfolios without reducing expected returns. Number two, overconfidence effect. Trade more does not guarantee higher returns. Number three, disposition effect. Tend to hold on to stocks that have lost value and sells stocks that have risen in the value since the times of purchase. Number 4, sensation effect, tend to seek for intense risk-taker experiences. Number 5, familiarity effect, tend to invest in familiar firms. Number 6, relative wealth effect, tend to compare the performance of their portfolios with that of their peers. Number 7, herb effect, tend to imitate others. Here, the effects that cause excessive trading are sensation seeking and overconfidence. The effects that cause diversification are familiarities effect and relative wealth effect. The effects that are not systematic trading biases are familiarities effect and overconfidence effect. So that was it for today. Now we are going to go over a couple practice problems. Number 1, which of the following statements about market anomalies are true? Number 1, for IPOs, the high returns observed in the first few days after a new issue are often followed by relatively poor performance in the years ahead, suggesting that investors underreact to the initial news. Number 2, investors typically overreact to earning announcement, causing a subsequent price adjustment. Number 3, the momentum effect is inconsistent with the weak form market efficiency. Here, the first statement is false. For IPOs, the subsequent poor performance after the initial run-up suggests that investors overreact to the initial news. So it should be overreact. The second statement is also false. The investor typically underreact, not overreact. Underreact to earning announcements, causing a subsequent price adjustment. Statement 3 is true. The weak form of EMH states that prices reflect information contained in the record of past prices and investors cannot make consistent profits from analyzing past data. The momentum effect suggests that there is a positive zero correlation in stock prices. Thus, price patterns exist and can be exploited by analyzing historical price information, which contradicts with the weak form of EMH. Problem number 2. Which of the following statements about calendar time anomalies are true? Number 1, stock returns have been observed to be lower in December than in other months. This is true, right? Number 2, stock returns have been observed to be higher on Friday than other days. This is also true. Number 3, stock returns have been observed to be more volatile during the middle of trading day than towards either the beginning or the end of the trading day. This is false. It should be the opposite, right? So we got statement 1 is true, statement 2 is true, statement 3 is false. So statement 3 is the only statement that is false. Number 3, which of the following results in excessive trading according to corporate finance by Burke and Marzo? Number 1, familiarity bias. Number 2, relative will concerns. Number 3, overconfidence bias. Number 4, sensation seeking. So here, excessive trading. Remember, I have note on the slide. Excessive trading should be sensation seeking and overconfidence, right? So it should be 3 and 4. Question number 4. James is an author with Actex, a publishing company listed on the New Hartford Stock Exchange. He invests 10% of his earnings in stocks of Actex since he has been working with this company for more than 10 years. Occasionally, he buys stocks of ASM, a competitor of Actex. Which of the following, according to Corporate Finance by Burke and Marzo, is referred to as the behavior pattern of James? There should be Which one? Number 1, familiarity bias. Number 2, relative will concerns. Number 3, overconfidence bias. Number 4, sensation seeking. It should be number 1, right? Because he tend to invest into familiar firms, right? He's been working here for 10 years. He's familiar with this company, so he invested in this company. So it should be number 1, familiarities bias. Problem number 5. Kimmy bought stocks A, B, C, D at time 0. You're given the following stock prices. Stock A, B, C, D with the price at time 0 and price time 1. Which of the following is true at time 1 with regard to the disposition effect discussed in corporate finance by Burke and DeMarzo? Remember this disposition effect. Here we got 5 options. Kimmy will likely sell stock A and B. Kimmy will likely sell stock C and D. Kimmy will likely buy additional stock C and D. Kimmy will likely buy additional stock A and B and sell C and D. Kimmy will likely buy additional stock C and D and sell A and B. Here remember the disposition effects. Investors tend to hold on the stocks that have lost value and sell stock that have risen in value since the times of purchase. So here we should go for C and D. You see that because the value of C and D are increasing, while A and B are decreasing. So it should be the second option here on the left. Kimmy will likely sell stock C and D. Alright. So after finish this lesson, the target of this lesson is to explain the main findings of behavioral finance. You should be able to identify empirical examples of market anomalies, understand the main types of anomalies like time-based, time calendar anomalies, overreaction, underreaction anomalies, and some other anomalies and bubbles. And you also be able to understand the behaviors of individual investors. We got a couple effects. Alright, so that was it for today. Thanks so much for watching my video. I hope you guys enjoyed my video, and see you on the next video. Bye bye.